At exactly 3 in the morning on January 3rd, 2026, the geopolitical landscape of South America shifted forever. American Special Forces successfully executed a high-stakes extraction of the Venezuelan leadership in Caracas. While the world watched the headlines about political transition, the real story was hiding in the ledgers of Beijing. Within hours, $23 billion in Chinese loans to Venezuela essentially evaporated into thin air. But what looks like a catastrophic financial loss for China is actually the first domino in a masterfully calculated pivot into the global silver market. To understand what is coming next, you have to look at the 48 hours preceding that extraction. On January 1st, China activated a restrictive new export control framework on silver, a strategic metal where they control nearly 70% of the global supply. This is not a coincidence of timing. It is a financial pincer move. You are currently standing inside a narrow 3-week window that will determine the winners and losers of the next decade in metals trading. While retail investors are distracted by the noise of the news, a mechanical collision is happening behind the scenes. We are seeing a massive debt default in South America, a strategic lockdown of industrial supply in Asia, and a forced $5 billion liquidation on Wall Street. This convergence is creating a temporary price distortion that most will mistake for a market crash. Between January 8th and January 15th, institutional index rebalancing will push silver prices into a controlled freefall, potentially hitting targets as low as $67. However, this is the trap. The physical reality of the market is screaming a different story. In Shanghai, physical silver is already trading at a massive premium compared to the paper contracts in New York. We are witnessing the death of paper silver and the birth of a new era of commodity dominance. If you understand the math of scarcity and the logic of geopolitical survival, you will recognize that the next 14 days represent the most significant accumulation opportunity of our lifetime. By February, once the forced selling exhausts and China's export quotas take full effect, the window will slam shut. This is the story of how $23 billion in lost debt is being weaponized to break the Western silver market. Welcome to the 3-week window that changes everything. To comprehend why the silver market is about to explode, we must first look at the wreckage of China's foreign investment strategy in South America. For over 15 years, Beijing acted as the primary lender of last resort for Caracas. This was not a typical banking relationship. It was a strategic exchange of capital for resources. China funneled billions into Venezuelan infrastructure and state oil operations, with the explicit agreement that repayment would be made in shipments of crude oil and physical gold transfers. According to research from the Inter-American Dialogue in early 2024, China's outstanding exposure to Venezuela sat at a staggering $23 billion. These loans were structured with payment schedules extending well into 2027. However, the American military intervention on January 3rd of this year has rendered those contracts functionally worthless. When a new government takes power under the direct coordination of American military assets, the previous regime's debt to a geopolitical rival is the first thing to be deleted from the books. China now faces a harsh reality. They cannot send debt collectors to a country guarded by American carrier strike groups. This $23 billion hole in their balance sheet represents more than just a financial loss. It is a loss of face and a loss of future energy security. In the world of high-stakes global finance, when a creditor realizes they will never be repaid in cash or oil, they immediately pivot to the one thing they can still control: the physical supply of critical industrial materials. The history of economic warfare shows us that sophisticated state actors do not simply accept a loss of this magnitude. They compensate by creating scarcity in other markets where they hold a dominant position. By losing their grip on Venezuelan oil, China has been forced to accelerate their Plan B. This involves moving away from dollar-denominated debt and toward the absolute control of the silver supply. This is the classic pivot from ghost money to hard assets. China understands that while the Americans can seize a government in Caracas, they cannot easily replace 70% of the global silver export capacity. The evaporation of the $23 billion Venezuelan debt was the final trigger. It transformed China from a participant in the silver market into a strategic predator, ready to use their monopoly to recover their losses at the expense of Western industrial stability. When you cannot collect $23 billion in cash, you collect it in leverage. In December 2025, the Ministry of Commerce in Beijing published a document that most Western analysts ignored. It was a detailed framework for the export of silver and other critical metals. This framework did not just suggest oversight, it established total state command. By January 1st, 48 hours before the events in Caracas, this plan was officially activated. The mechanics of this framework are a masterclass in industrial warfare. Moving forward, only 44 approved companies are permitted to export silver from China. To even qualify for a license, a company must maintain a minimum annual production of 80 tons. This high threshold is not a random number. China produces roughly 4,600 tons of silver annually. By setting the bar at 80 tons, Beijing has effectively eliminated hundreds of small, independent refiners and regional processors from the global market. This centralizes the entire silver export capacity into the hands of a few state-connected giants. These 44 companies do not answer to shareholders. They answer to the quota systems of the central government. In practical terms, this means Beijing now has a digital kill switch for the global electronics and renewable energy industries. They are no longer just participating in a market. They are writing the rules for who gets to manufacture solar panels, electric vehicles, and high-tech weaponry in the West. The Ministry of Commerce has shifted the strategy from trade to allocation. Under the new rules, silver is no longer a commodity sold to the highest bidder. It is a strategic asset allocated to partners who align with Chinese interests. If you are an American manufacturer relying on Chinese silver, you are no longer negotiating a commercial contract. You are navigating a geopolitical minefield. This is how China weaponizes its supply chain to offset the $23 billion loss in Venezuela. By creating an artificial bottleneck, they ensure that the price of physical silver in the East stays high while they can simultaneously manipulate the scarcity in the West. They are converting their lost oil debt into a permanent tax on Western technology. As the global silver deficit grows, the power of these 44 licensed exporters grows with it. We are no longer talking about a free market. We are talking about a fortress of metal. While China is tightening its grip on physical supply, the Western financial markets are about to trigger a massive, automated sell-off. This is the phenomenon known as index rebalancing. To understand why silver prices might suddenly drop to $67 despite a global shortage, you must understand the mechanical nature of modern passive investing. Every January, major commodity indices, including the Bloomberg Commodity Index, adjust their weightings to reflect new market conditions and price performance from the previous year. For 2026, the institutional mandates have shifted dramatically. According to a December report from J.P. Morgan, the Bloomberg Index is scheduled to reduce the weighting of silver from approximately 9% of the total index down to under 4%. This sounds like a small adjustment, but in the world of institutional finance, it is a tectonic shift. Passive investment funds that track this index are contractually obligated to match these weightings exactly. This means they do not have the luxury of market analysis or human judgment. They must sell. The calculated value of this forced liquidation is roughly $5 billion. This capital will flow out of silver and into other commodities during a specific execution window from January 8th through January 15th. The heaviest concentration of this selling pressure typically occurs between January 9th and January 11th. During these 72 hours, multiple multi-billion-dollar funds will execute their trades simultaneously. They do this to avoid front-running each other, but the result is a massive wall of sell orders hitting the market at once. What makes this rebalancing particularly dangerous this year is the current state of market liquidity. Data from the CME Group shows that daily trading volume for silver futures has declined by 35% compared to the same period last year. When $5 billion in forced selling hits a market with reduced liquidity, the price impact is amplified. Each dollar sold moves the needle twice as far as it would in a normal market environment. This is why the math points to a 12 to 18% price drawdown during this window. Retail investors will see silver prices dropping from the mid-80s down to the high 60s, and they will panic. They will assume the silver rally is over or that the industrial demand has collapsed, but they are wrong. This selling has nothing to do with the fundamental value of silver or China's new export restrictions. It is a mechanical requirement of a spreadsheet on Wall Street. The sophisticated players, including the central banks of the East, know exactly when this window opens and when it closes. They are waiting for the forced sellers to exhaust their inventory so they can begin the greatest accumulation phase in history. To see through the fog of the January price drop, we must look at the cold, hard mathematics of global supply and demand. The Silver Institute published preliminary data for 2025 that reveals a structural deficit that cannot be ignored. Global silver demand reached 1.24 billion ounces last year, driven by a massive surge in industrial applications. However, total global supply, which includes both primary mining production and recycled metal, only reached 1.01 billion ounces. This leaves a shortfall of 230 million ounces in a single year. This is not a one-time anomaly. The world has been running a silver deficit every year since 2020. When you run a deficit of this magnitude, you must draw from existing inventories to fill the gap. But those inventories are reaching a breaking point. Warehouse stocks at the COMEX in New York tell a terrifying story for industrial buyers. Registered silver, which is the metal specifically available for delivery against futures contracts, has collapsed by 70% since 2020. We have watched inventories drop from over 400 million ounces to under 120 million ounces. At the same time, the open interest in silver futures contracts remains high. This means there are far more paper claims on silver than there is physical metal sitting in the vaults to back them up. In a normal market, higher prices would encourage more mining, but silver is primarily produced as a byproduct of lead, zinc, and copper mining. You cannot simply flip a switch to produce more silver just because the price goes up. Now, consider the impact of India's voracious appetite. Customs data from October 2025 shows that India alone imported 1,700 tons of silver in a single month. That represents nearly 37% of China's total annual export capacity absorbed by just one nation in 30 days. When you combine this relentless physical demand with the fact that solar panel manufacturing requires 20% more silver per unit than it did 3 years ago, the math becomes undeniable. The $23 billion that China lost in Venezuela is a drop in the bucket compared to the value of controlling a market that is short by 230 million ounces every year. By restricting exports through their 44 approved companies, Beijing is effectively cornering a market that was already starving for physical metal. The forced selling by Western index funds in January is creating a temporary illusion of plenty in a world of extreme scarcity. Once the $5 billion in paper silver is sold, the market will be forced to confront the physical reality that there simply is not enough metal to go around. If you want to know the true value of silver, you must stop looking at the digital screens in New York and start looking at the physical warehouses in Shanghai. We are currently witnessing a historic structural disconnect known as the Shanghai Premium. While the COMEX futures in America are showing prices suppressed around $32, physical silver on the Shanghai Gold Exchange has been trading between $70 and $80 per ounce. This is not a minor fluctuation. It is a 140% premium for physical metal in the East compared to paper promises in the West. In a functional global market, arbitrage traders would quickly close this gap by buying silver at $32 in New York and selling it for $75 in Shanghai. But that is not happening. The gap is not closing. It is widening. The reason is simple and devastating for the Western financial system. You cannot easily convert a COMEX paper contract into physical metal that clears Chinese customs. The paper market in the West has become a giant game of musical chairs. There are hundreds of paper claims for every single ounce of physical silver held in Western vaults. Sophisticated buyers in Asia have realized this. They are no longer interested in trading digital digits on a screen. They want the physical bars. This is why China is willing to pay double the Western price. They are valuing silver not as a speculative trade, but as an essential industrial fuel for their future. This divergence is a direct signal that the Western pricing mechanism is broken. When the physical metal moves from west to east at such a massive premium, it indicates that the COMEX is no longer a tool for price discovery, but a tool for price suppression. By keeping the paper price low, Western institutions allow index funds to exit their positions during the January rebalancing without triggering a total market panic. However, this strategy has an expiration date. Once the institutional selling in New York exhausts itself around January 15th, the market will be forced to reconcile with the Shanghai reality. You cannot run a global industry on $32 paper silver when the physical reality costs $80. As China enforces its new export quotas, the West will find that the only way to attract physical silver back to its shores is to let the price rise to match the Eastern reality. The bridge between $32 and $80 is about to be crossed, and the crossing will be violent for anyone caught on the wrong side of the trade. The transition from dollar-denominated debt to hard assets is not a new strategy. It is the standard operating procedure for any empire facing a systemic threat to its currency. To understand China's current pivot, we only need to look back at the events of February 2022. When the Western financial system frozen over $300 billion of Russian foreign reserves, the world saw the ultimate risk of holding dollar assets. In the 18 months following those sanctions, Turkey, a nation at the crossroads of East and West, accumulated over 900 tons of gold. Turkey is not a major domestic producer of the metal. They were intentionally converting their dollar exposure into a physical asset that could not be frozen, canceled, or devalued by a central bank in Washington. They realized that in a world of geopolitical conflict, a bank entry is an opinion, but a gold bar is a fact. China learned an even more direct lesson during Venezuela's previous debt crisis in 2017. When Caracas first began to default on its international obligations, Beijing did not wait for a restructuring committee to meet. They immediately changed the terms of their engagement. They stopped accepting promises of future oil revenue and began demanding direct gold shipments as debt payment. Bloomberg reported at the time that massive amounts of physical gold were moving from the vaults of Caracas to Beijing while the Venezuelan bolivar was collapsing into worthlessness. This historical pattern is exactly what we are seeing repeat today with silver. The $23 billion loss in Venezuela is the trigger for China to exit the dollar game and enter the commodity game with full force. History shows us that when a creditor realizes the debtor can no longer pay, the creditor moves to seize the collateral. In this case, the collateral is not just a single mine or a piece of land. The collateral is the global supply of silver itself. We have seen this movie before. In the 1970s, the Hunt brothers attempted to corner the silver market, but they failed because they were private individuals fighting against the entire regulatory weight of the United States government. Today, the player is not a pair of brothers. It is a nation-state with a $3 trillion war chest and control over 70% of the global supply. When a sovereign power with historical memory decides to pivot from paper to metal, the result is never a minor price move. It is a total restructuring of the global monetary order. The true value of silver is not found in a jewelry store or a coin shop. It is found in the heart of the modern world. Silver is the most conductive element on the periodic table, and in the race for technological supremacy, it is not optional. On January 2nd, Elon Musk tweeted a simple but chilling response to China's export restrictions. This is not good. He was not talking about his personal portfolio. He was talking about the physical survival of Tesla and SpaceX. Every electric vehicle manufactured today requires between 25 and 50 grams of silver for its electrical contacts, sensors, and battery management systems. This is double the amount used in a traditional internal combustion engine. With Tesla aiming to produce millions of vehicles annually, a supply chain disruption at the source is a direct threat to production. You cannot build a car with a silver futures contract from New York. You need the physical metal delivered to the factory floor on a predictable schedule. The vulnerability extends far beyond the automotive sector. The global transition to renewable energy is effectively a transition to silver. Solar photovoltaic cells consume roughly 10% of the total global silver supply annually. As the efficiency of solar panels increases, the loading of silver per cell has actually started to rise again due to new technological architectures like TOPCon and HJT. These technologies require even more high-quality silver paste, much of which is processed in China. When 44 Chinese companies control the export licenses, they are not just controlling a price, they are controlling a permission slip for Western industry. If Apple, Tesla, or Samsung cannot secure physical silver because of China's quota system, their production lines stop. This creates a state of panic buying that the paper markets have not yet priced in. Procurement officers at major corporations do not care about the Bloomberg index rebalancing. They care about inventory. This is the industrial trap. While Wall Street is busy selling paper silver to meet an arbitrary index weighting, industrial giants are beginning to realize that the physical metal is disappearing into the East. We are moving toward a moment where the industrial demand will decouple entirely from the financial price. When a manufacturer is faced with the choice of paying $100 per ounce or shutting down a multi-billion-dollar factory, they will pay the $100. China knows this. By losing $23 billion in Venezuela, they have gained the leverage to extract hundreds of billions from the Western industrial base through the control of silver. We are now approaching the eye of the storm. To understand where the price of silver is headed, we must look at the calendar with mathematical precision. The window from January 8th through January 15th is the zone of maximum technical pressure. As the $5 billion in forced institutional selling hits the market, we expect to see a localized price floor established between $67 and $72. This is not a collapse. It is a mechanical transfer of wealth from passive funds to sophisticated accumulators. The real shift begins after January 15th. Once the Bloomberg index rebalancing is complete, the massive wall of sell orders will simply vanish. In a normal year, this would lead to a standard mean reversion rally of 8 to 15%, but 2026 is not a normal year. As the technical selling exhausts itself, the market will hit a brick wall of fundamental reality, the full enforcement of China's export framework. By February 1st, those 44 approved Chinese companies will receive their final quota allocations for the first quarter. For the first time, Western industrial buyers will be competing for a limited, state-controlled pool of silver in a market already short by 230 million ounces. This creates a supply shock that will collide with a market that has just been artificially suppressed. We are not just looking at a recovery, we are looking at a scarcity-driven explosion. The target of $85 to $100 by the end of February is not a speculative guess. It is the price discovery required to close the gap with the Shanghai premium. As the paper markets in New York are forced to recognize that they cannot settle contracts without physical metal, they will be forced to bid the price up to attract supply. The divergence we saw in January will collapse, not by the Shanghai price coming down, but by the New York price racing to catch up. This move will be accelerated by the panic of industrial procurement officers. When they see the price rebounding from $67 and realize that Chinese exports are being throttled, they will move from just-in-time inventory to just-in-case stockpiling. This double whammy of a technical rebound and an industrial supply squeeze creates a vertical price trajectory. The month of February will likely be remembered as the moment silver transitioned from a neglected commodity to a strategic weapon of economic sovereignty. The events unfolding in the silver market are not random. We are witnessing a fundamental realignment of global power where physical assets are reclaiming their throne from paper promises. The loss of $23 billion in Venezuela was the match that lit the fuse. China is not merely reacting to a bad loan, they are executing a long-term strategy to ensure that the next era of industrial growth is built on their terms. As a viewer of this channel, you now possess a piece of intelligence that the broader market is missing. Most investors will spend the coming days watching their screens in confusion as silver prices dip towards $67. They will listen to the mainstream media talk about volatility and risk. They will act on emotion and panic, selling their positions at the exact moment when the largest state actors in the world are preparing to buy. The choice you face between January 8th and January 15th is a test of conviction. You must decide if you are a retail trader reacting to 3-day price moves or a strategic investor understanding a 3-month market structure. The window is exactly 13 days long. Once the forced selling by index funds exhausts itself and the Chinese export quotas become the primary driver of price, the opportunity to position at suppressed levels will be gone. This is not about a get-rich-quick scheme. This is about recognizing a rare moment when geopolitical loss, mechanical market failure, and industrial scarcity converge at a single point in time. The players who understand that silver is being weaponized to offset the collapse of dollar-denominated debt are the ones who will thrive in the coming years. Whether you hold physical metal, mining equities, or silver-backed instruments, the next few weeks will test your resolve. But remember the math. Remember the 230 million ounce deficit. Remember the $67 target during forced selling and the $80 reality in Shanghai. The window is closing in real time. Sophisticated money is already moving. The only question left is whether you will be positioning for what is coming or reacting to what has already happened. This is Content Financial. Watch the window, position accordingly, and stay ahead of the noise.